Of course, we've got Aaron Smith with us now. He's Managing Director of Superfund Financial. Aaron, very interesting what we're seeing when you look at what's going on with the price of gold. And it seems like as we get more, I guess, encouraged about the state of the US economy and any economic recovery there, there seems to be less need in the market to actually hold gold. Is this the start of a longer-term correction? Because you've been a gold bull for some time.
Yeah, Oriel, it is interesting, but it's not unexpected.
Yeah.
If you look at the volatility of gold over the past 30 years, it's 17.7%. So this type of price action is completely normal within the statistical probability of the variance of gold. So this pullback is actually quite normal. We don't see it breaching strong technical levels. So if you look at the long-term trend lines and you look at the long-term moving averages, we see strong support for gold in the region between 1280 to 1300. So that means you have a cushion there where you can continue buying. And unlike, safe haven currencies like, say, the Swiss franc, which have less volatility, this could actually be a buying opportunity for long-term investors.
But we're above 1300, right? You're talking about 1300 was a top.
Yeah, that's a support level. So between
bottom line resistance.
Yeah.
So we don't.
So you can still buy.
We think that gold can trade and have plenty of support between 1280 to 1300 before any of the long-term money is being mobilized.
Okay.
See, what's happening now is once that earlier in the month, once the 50-day moving average got breached, a lot of the trading money, the hot money, pulled out of gold, which has caused this sell-off. But let's go back to the last summer. The same sell-off we saw in August ended up being a fantastic buying opportunity. Gold was trading around 1160 after it sold off for 4 weeks in a row, and then it just had a huge jump for going out
Aaron,
from there.
Gold does really, really well in times of mass uncertainty. When people think that central banks are going bust, that sovereigns are going to default, governments are going to fall, and everything like that, and basically, mass anarchy is going to break out. I think the years have proven since the global crisis that the world is anything but that. Times are tough, but people are finding ways out of things. If you were parked in gold making zero yield except for the capital gains the last few years, you would have been beaten to a pulp by some of the emerging markets, by some of the currency pairing opportunities out there. For heaven's sakes, the U.S. Stock market, the Hang Seng, 24,000. There's a lot of other opportunity out there. What's going to be the catalyst on the second leg?
You don't look at a gold as an alternative to emerging markets or to equity positions. You look at it as an alternative to cash. And so the answer is that even if gold performs poorly, it will perform better vis-a-vis food. Food inflation is going to be a major theme going forward. It will perform better vis-a-vis energy than dollars, euros, yen, or any other mass-produced paper money, which is growing in supply. The supply of gold is more or less finite and only growing at about 0.5% a year. So 170,000 tons worldwide. That's 18 Olympic-sized swimming pools. That's hardly changing next year, the year after. Supply of U.S. dollars growing exponentially. Yen growing exponentially. Euro growing exponentially. So how much corn, sugar, copper, how much food and energy could you buy 2-3 years down the road? So holding gold is not a play like an emerging markets play where you're trying to get that double-digit return. It's a safe haven alternative to cash.
Your back's up. Well, in Australia, you're getting, what, 4.5% for cash, so you're actually better off in cash than you are in gold if you're investing in Australia.
A certificate of deposit? 4.5%, really?
Yeah, about 4.5%, obviously, depending on where you go. But.
What do you do with gold? How do you approach gold then? Do you, that's kind of the usual housekeeping question, but paper gold, ETF, do you buy the mining names that you think have a lot of proven reserves that they haven't entirely tapped?
Well, a lot of the miners, and this goes for commodity companies in general, generally have a high debt-to-equity ratio. I haven't found any commodity companies that aren't leveraged. So when I buy a physical asset that has no liability attached to it, why should I inherit all that leverage? So the idea is I'd rather get physical exposure to the actual product. The next best form of paper gold, I would say, would be gold futures, because that gives you an actual contract with the exchange which guarantees delivery of the product, and you don't have to worry about filling up the living room with a couple thousand kilos of gold.
Oh, I wouldn't mind doing that.
Oh man, I can't sacrifice my living room like that.
Yeah, well, you probably don't have the space, actually, given you do live in Hong Kong. We've been spending a lot of time looking at property.
She says that we live in tiny little ramshackle sheds here.
Oh, well, that wasn't quite my turn of phrase, but What about silver, Aaron?
Silver is sort of a leverage play on gold, certainly more volatile historically, potentially more upside if you can buy the dips, but then again, it's going to be more risky. So the other factor that you have to consider is that silver and platinum are going to have a higher sensitivity to the S&P 500, whereas gold is going to have less correlation to S&P. So if you're looking for the diversifier, gold's better. But if you're looking for more of a value play, silver, perhaps even platinum, could give you more upside potential, especially if we see a recovering economy.
Love silver, but it tarnishes. You have to wipe it every month.
And platinum is probably a better way to go.
Well, it makes better settings for solitaires, I find. Some people like white gold, you know, the yellow gold, but I think 9 out of 10 people would choose the platinum setting.
What does Cindy have?
Platinum,
and all the way.
Platinum.
And diamonds, and diamonds. All righty, Aaron, good to have you with us. Thanks for joining us today. Aaron Smith from Superfund Financial. That's it for the first